The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. A no-go, Iran's draft plan to reopen the Strait of Hormuz reportedly bans vessels from hostile countries, including the US and Israel. But a US official tells CNBC any temporary routes must be without any impediments. AI funding back at the fore as Alphabet raises $25 billion in debt. And Kansas City Fed President Jeff Schmid questions whether the industry is becoming another too big to fail.
China reaps the rewards of strong global demand for its high-tech components, exports rising almost 24% in July. President Trump, meanwhile, imposing a 15% tariff on poly-silicone products targeting chip and solar supply chains. Futures in Europe and the US trading along the flat line as investors brace for July's payrolls print in the States. Economists expecting a pickup of around 83,000 jobs, boosted in part by the World Cup. Hello, welcome to the programme. A draft plan to manage the Strait of Hormuz would reportedly see US and Israeli ships blocked from transiting the critical waterway. That's according to Iranian state media, with Tehran also seeking to prevent the passage of those who've caused damage to the country until it is, quote, compensated. Iran is planning to issue penalties, including up to 20% of the cargo value of those in violation, according to that report. The reported terms appear to be quickly rejected by the United States. When asked about the FAR's report, a US official told CNBC any temporary routes would be without any impediments. We'll have more on that story and the impact for the oil markets throughout the show with Argus Media's head of European oil product pricing later this hour, as well as ING's head of commodity strategy at 9:15 London time.
Let's get up to speed on markets. It was a mixed session stateside yesterday. Very choppy action that we witnessed. If you just bury into some of the sectors, you could see FANG Plus stocks were trading higher in the session. We had a gain of about 1.3%. Banking stocks, they're reversing, down 1.2%. At the downside, really industrials, that was the steepest faller as a sector. Energy, the better performer. And really going back to the heart of some of those concerns around the Middle East and the situation, which again, as we looked to round out the week, different to some of the optimism we had earlier in the week, that we were hopeful of being very close to reaching another deal to try and lead to some sort of peaceful resolution. So the market just showing a little bit of disappointment in some areas and elevated risk. So what we had at the end, the Dow down by 0.8%, so backing off fresh records this week. The S&P 500 sliding 0.2 and more contained around the Nasdaq. As I mentioned, some of the tech performance in session yesterday, but there's been a ton of earnings to digest, of course. And what we've got as we gear up for the session later on today, the non-farm payrolls, that could be a test of the inflation story and just what we're likely to see on the interest rate scenario. To the Asian markets, the early picture across the board. We are bookend by red in the Japanese and the South Korean markets. Again, the sell-off has been fairly strong for those tech names in South Korea this week to the tune of roughly about 5%. And we're down for a 7th straight week. So telling you about that reset that has taken place in some of the DRAM stocks. But we've got patches of green across in the Hong Kong and the Chinese markets, just modestly upbeat. To European futures, despite some of that bumpiness I'm just describing, European stocks have performed nicely. We've had fresh records across on the benchmark this week on the Stock 600, 4 positive sessions in a row. We've still seen it dotted across various markets. French stocks yesterday, all-time highs, along with Italian stocks. A slight pullback on the DAX, but in the context we've had a lot of big earnings crossing, a lot of heavy market cap weighted stocks. So that had some impact on the DAX yesterday. It was only just slightly in positive territory. Ben.
Investors appeared to take advantage of what they saw as a discount on SpaceX shares on Thursday, with the stock closing the session more than 6% higher after its first lock-up expiry saw the available public float more than double. This after the stock's double-digit decline on Wednesday. Here's Morgan Brennan's take, as it was ahead of the open.
The first wave of insider SpaceX stock unlocks Thursday. Available share count balloons to more than $1.5 billion from $629 million in the IPO, and that is just the start. So billions of shares unlock into 2027. By January, 50% of shares are in free float. That's according to Bernstein. The key question, who's eligible to sell and when? That matters when determining how much supply could in fact come to market. For many employees, lockup expirations start on Thursday. Senior executives and officers are subject to longer lockups, and Elon Musk, who overall owns 42% of the company, can't sell until June of next year. But if history is any indicator, he likely won't. And he's not alone. Many longtime investors plan to hold and have been very public about it. Something else to consider. Insiders had liquidity events before the IPO via secondary share sales 2 times per year. That said, the last one in December valued SpaceX, which had not yet absorbed XAI, at $800 billion, reportedly. Even with a stock tumble on Wednesday, market cap on Thursday was about $1.4 trillion. So some may still take some profit. JPM argues, quote, there has already been significant pre-positioning ahead of this first expiration, the largest of many over the next several months. Bottom line, it's not a typical stock lockup expiration. Don't expect typical stock trading reaction, especially amid reports of surging retail buyer activity. For CNBC Business News, I'm Morgan Brennan.
Alphabet closed Thursday's session in the red, the laggard on the S&P 500 after it raised $25 billion in debt in the latest funding round pegged to AI from the hyperscalers. The move puts its total issuance since the beginning of last year at more than $114 billion, making it the biggest seller of AI-related bonds in the time since. This as Fed officials begin to weigh in on growing jitters over AI spending. New York Fed President John Williams told Reuters that investors' efforts to grapple with the implications of the technology will lead to volatility, saying that, quote, investors are trying in real time to solve an almost intractable problem. Meanwhile, Williams' colleague at the Kansas City Fed, Jeff Schmid, has wondered whether the industry is becoming another case of too big to fail, while San Francisco Fed Chief Mary Daly called the growth rate of AI investment worrisome. US President Donald Trump has announced a series of trade actions aimed at bolstering the domestic chip and solar supply chains required to compete with China in areas like energy and artificial intelligence. The president's executive order imposes a 15% tariff on products made from poly-silicone, also setting minimum import prices on the raw material and related products set to take effect from early December. Well, Stephen New joins us now, the CIO at Blue Whale Growth Fund. Stephen, thank you very much for joining us today. It has been incredibly eventful in the technology space. We've had earnings, we've had more deep capex intentions, funding announcements, and of course disruption coming from the open weight models, both in China and the United States. Just piece it together in terms of what you think is most pressing for investors to think about.
Yeah, I think that obviously there's been a lot of news that just came out over the last few weeks, and that's caused a lot of jittery within the AI names recently. And I think ultimately the question investors have to ask themselves is how much do we think AI is going to change the world? And then you have to assess then the level of adoption, the penetration, how many use cases are we being is available today? And if you believe that we are at the end of the journey, then obviously we have got too much AI infrastructure, we got too many AI data centers. But if you think like we're at the early or the beginning of that journey, or even in the middle part of the journey, then I think that's quite a long runway to go.
It's very interesting how you've conceptualized that, because to me it's been this sci-fi era that the Frontier Labs are now marketing, that AGI is within touching distance. And this was the purpose. The mission statement for OpenAI was to get to AGI before anyone else. Others are now trying to prove they're close. All these hacking stories that have been released that, look, the technology is so powerful, it got out of a sandboxed environment. This is the point, isn't it? How useful it will be is quite different if we get to AGI.
I think that's right. I think the one thing, firstly, just to take into account is like enterprises in terms of adoption is still quite at a primitive level, and then a lot of the technologies that's available today, we probably don't need that in most corporations, right? Like if you talk about the AGI, that's very advanced. Like you were talking about probably in some very advanced science or maybe healthcare, and that might be useful. But I think on most of our day-to-day, in terms of like just making some enterprises more efficient, you don't need all that. So then obviously ultimately we're going to see a spectrum of different use cases in terms of like you will end up probably paying for that as well if you want to use a very advanced AI just to perform certain tasks.
The point I'm raising is whether we've still got parts of the AI world in absolute hype mode, trying to keep investors on the hook, keep them invested while they get to some sort of breakthrough technology, or whether we're now getting to the point where we're pushing the limits on capital markets to what the Fed was talking about?
Yeah, I think that's a combination of a few things. I think one is that you need to track the rates of innovation. So at the moment, the rates of innovation is still happening. So that's very important, right? Because at some point when the rates of innovation is plateauing, that you're not going to see more advancement, then maybe you say you can then decide whether how long this is going to last. But then secondly, you also need to look at the adoption and the penetration in terms of use cases, which I think the use cases at this moment in time is still quite limited or not yet highly penetrated. So when you put the two together, I think we are still in a very good shape in terms of where we're going.
Stephen, the commentary that you provide around your fund is that you position the portfolio on the receiving end of AI-related spending rather than the companies funding it. To me, that seems very logical. But one of the things I've kept asking our markets and strategy guests is I'm really confused as to why, when we see the hyperscalers, the big tech companies announce greater capex, you would think that means a greater flow of money to the chip makers, to those on the receiving end, and so their stock price should rise. And yet, there are times where there's the big capex spending, there are the jitters reflected in the big tech hyperscalers stock, and then we also see those on the receiving end see their shares fall. What's going on there? Can you give some kind of rationality and clarity? Because that's where your portfolio is very much positioned, isn't it?
Yeah, I think there's probably a bit to do with the rate of change as well. So if you look at the big tech spenders, AI spenders over the last few years, I think that capex budget has been doubling over the last few years. And if you look at the rate of change going forward, it's probably unlikely to be doubling, right? We are talking about a very big number here. Like this year's alone is about over $700 billion. Next year, it can't be 1.4, and then you double again to $3 trillion, I think. I mean, we've seen Alphabet's raising money from the debt market as well. So I think that's a bit of rate of change. But at the same time, though, I think very importantly, you have to look at some of the valuation of the AI infrastructure names like your NVIDIA, like some of the memory companies. I mean, they are not trading at insane valuation, right? You talk about NVIDIA trading at less than 20 times earnings. You're talking about some of the memory company trading at 5 times earnings. So they are not even like in the scale of like your SpaceX that you're trading at 200 times earnings, that you have to expect them to grow materially from here. Then you have to ask the question, like, how much growth do you expect for shares like NVIDIA trading at less than 20 times earnings? Surely that's not going to be 50% or 100% a year in terms of capex, incremental capex, right? So then if over time, we also expect there's going to be like a maintenance capex. So it's a bit like your iPhone that everyone probably upgrade an iPhone every few years. And then the ecosystem is like, you need to like replenish that, and compute is probably similar as well. So then ultimately the rate of change in capex is going to slow down, and then it's about the valuation of the company and whether NVIDIA or some other AI infrastructure names would remain in their position to capture some of the spending.
Yeah, I'm interested to get your thoughts as well on the development. It was about a week ago, Korea announced that it was going to, the authorities would ban single stock leveraged ETFs. Now, if the heavyweights, some of the chip makers there, SK Hynix, Samsung, if they had done calculations based on being able to raise funds through the fact there was this ample flow of capital through some of these single stock ETFs into them to meet the demand for their chips and to have that money to do it, how much does this affect their position? The fact that capital won't necessarily be flowing in the way they might have expected.
Yeah, I probably don't think that would be any issue at all. I think you also need to go back to the valuation of, let's say, Hynix, for example, which we owned in the fund, is they're trading around five times earnings 1 year forward. Like they are net cash on the balance sheet, 50% free cash flow margin. They're generating over $100 billion of free cash flow just on the balance sheet. Obviously, the capex plan is quite a lot in the next few years. And at the same time, I think when you look at some of the contract they have done with their customers, now they have been shifted away from the shorter term kind of like pay-as-you-go model, or maybe just place an order and then the inventory will be there. Like you need to commit long term, right? So when you then have like visibility in terms of long term commitments on the product that you're selling, then you get more visibility. At the same time, you probably be able to raise more money from the debt market if you need to. But I think as far as Hynix or Samsung is concerned, I mean, we don't think they actually need to raise money because they have been on the receiving end of any spending, right? Unlike Alphabet has been spending money investing to AI.
I want to get into some of these names because you initiated a position in SanDisk. The stock was down this week on the back of earnings, not quite what analysts had anticipated. And you've also mentioned Alphabet, but one of the other exposures then, of course, there's been quite strong moves this week in the leadership team. It feels as though to double down on Gemini. What was your reading on both of those stocks?
I think SanDisk, we're relatively comfortable. I think in terms of memory, we hold three companies, Seagate, SanDisk, and Hynix. I think one of the things that we find really excited about is like if you go into you dig deeper within the AI infrastructure spending, some of the spending are not repeatable. So let's say your construction, building out a new AI data center, but then there's certain things that are repeatable or recurring. And I think one of the things that we identify is memory. If you think about what AI is about, it's about personalization, it's about more data available, either it's generated by AI or interaction with AI. We need to store all this data somewhere. So we're going to see an explosion of data. And we just have shortages of memory. It's a bit similar to when we all have our personal devices. Just imagine how many photos or videos or whatever we have got on our smart devices, and AI is going to be even more powerful than that. So I think
comparison. I think we're all running out of storage.
Yeah, exactly. So I think memory on its own, like even though like maybe we would have all the AI data center already been built at some point, but then data generation, personalization is going to continue for a long time. And you think about your agentic AI, personalized agents and all that not even started, isn't it? Or personalized advertisement. The second thing about the, in terms of Alphabet, obviously, at the moment, we're predominantly positioned within the AI infrastructure names who are receiving the spending. We do think there's going to be the AI winners of tomorrow to emerge when you are spending money, your Anthropic, your OpenAI, or Alphabet, or Meta. But at this moment in time, it's very difficult to identify the winners. But then there are a few things that you can try to do, and I think what is really important is like you need to look at the data side, whether they do have the data. And Alphabet has the data. And then secondly, it's about whether they have the lowest cost of GPU compute, which they have their own TPUs, which is an advantage over other competitors who might need to buy NVIDIA GPUs. And then thirdly, you also need to see whether they have a good model. And obviously Gemini or even Google as a team has been very advanced in AI together. So when you put the three things together, it's actually a better winning formula than, for example, OpenAI or Anthropic that don't have any data, that do not have their own TPU or GPU compute, and they do have a model. So then they end up spending the money, right? At the same time, like Alphabet is highly profitable in a way that not that they don't need money, hence they're raising from the debt market, but they are highly profitable. They do have a business, which some others do not. So we think the likelihood of Alphabet being AI winners of tomorrow is a lot higher, but it's still a lot more difficult to do that. So it's easier to invest into a company that are receiving the money coming out from the spenders.
Stephen, great explanation. Thank you so much. Stephen, you're with us, CIO, Blue Whale Growth Fund.
Well, it's a Friday in August, but if you thought that meant a quiet news agenda, you are very wrong. We've got a packed show, and coming up, shares in Diageo jump as the drinks maker introduces a $1 billion cost-saving plan. We'll bring you the details. Plus, EasyJet agrees to a £5.7 billion takeover from Apollo. We'll discuss the turbulence ahead for the budget airline. And Alliance backs its full-year targets. We'll speak to the insurer's CFO after the break.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
And net profit at Allianz fell more than expected in the second quarter, down 8.7% on the back of restructuring expenses tied to AI. Despite this, the insurance giant posted total business volume growth of almost 6% and backed its full-year outlook. Shares pre-market are called around 1.5% lower. Let's get into the weeds on this with Claire-Marie Costa-Lepoutre, who is the CFO of Allianz. Claire-Marie, thank you very much for joining us today. It looks like it was not the easiest of quarters, so just explain what was going on behind the scenes.
Sure, I will explain, and good morning to all of you. So I think if you look at the first half, actually we had an excellent set of results for the first half. We achieved a record level of operating profit. Our core EPS is up 10%, our core ROE is at 19%, and both numbers are ahead of our targets, and as well our level of resilience is at its highest level since 2018. In addition to delivering those numbers, we are executing on our strategy. We are focusing on customer centricity, leveraging AI, and at the same time, you have seen that recently we have been deploying capital in particular in Southeast Asia. So while we have this effect, which is just a net income effect into the quarter that we had announced previously, that's just a mathematical view, overall, we are very happy with our performance. We are clearly on track for the delivery of our targets, and we are very confident for what is up to come.
Claire-Marie, just getting into the AI story then, how difficult is it to deploy AI? How disruptive is it proving? And what's the cost side of this going to look like, whether you need to buy something to plug into Allianz or whether you can build this organically?
So look, we have been working with AI for quite some time. If you look at what we have been communicated as well over many, many years, we have been using AI already in multiple parts of the organization. Now we are doing that much more at scale. We are doing that along the entire value chain. And we are in particular also focusing on leveraging AI for growth along two dimensions. I will say, like leveraging the productivity effects to inject that into our pricing, to enhance affordability of our products, but also to enhance purely at sales productivity, but also customer experience leveraging services. So we really are making very, very good progress, and we are very happy with what we are able to do, combining all our strengths, I will say scale, skills, technical excellence, data, and our brand as well, which is playing a very important role in that overall environment.
Claire-Marie, it's Ben joining the conversation here. I know that there have been some fairly significant acquisitions, Singapore United Overseas Bank, their asset management business. There's also the insurance business from HSBC. Just explain how that fits into your strategy looking forward, looking ahead.
Yeah, sure. So we have been communicated quite comprehensively about the fact that we believe Southeast Asia is a very important part of the world for us, and we wanted to establish ourselves more strongly in that setup. And in particular, what we are doing with those two acquisitions is to strengthen Singapore in becoming our retirement and wealth hub, out of which we will be able to service entirely across all types of products we can deliver our clients in the entire Southeast Asia region. So that's very important. And also for AGI, which is the acquisition of UOB asset management, we are also enhancing our ability to serve in countries where we were not able to do before. So that's basically the overall approach.
And then the other thing I'm keen to get your thoughts on, Claire-Marie, the twists and turns of what's happening in the conflict between the US, Israel and Iran is never far from the headlines. And at one point, Allianz Research talked about more than 1,000 cargo ships with carrying an estimated value of $125 billion were waiting to resume operations in the Gulf. What's the current view of Allianz in terms of how willing you are to ensure cargo and freight vessels and tankers going through that region, and whether you are looking at a premium being applied to the insurance costs that you levy on them, especially in the light of the recent announcements about a possible deal between Iran and Oman about controlling navigation through the waterway?
So maybe like just for us overall, right? The implication of the situation, the direct implication of the situation in the Middle East, number-wise, are not very relevant. We have very little exposure when it comes to this situation. Also, I think what we are really focused on in terms of management for the future and currently for us are the secondary effect of the situation, mainly inflation. And typically around inflation, what we have done also in the second quarter, we have been very cautious and we have already reflected inflationary effect into our reserves, and that represents, just to give you a sense, something like close to 300 million euros into the number in the second quarter. So that's the main focus we do have as an organization currently.
Claire-Marie, just piece it together with the property and casualty insurance, where we've seen modest growth. It's been a decent performance for the business in that area. What are the big dynamics playing out there, whether it's the macro, whether that's catching up with that, some of the inflation concerns we've been talking about for years?
Yeah, so I think there are multiple effects, and you are right to say that our level of growth is nuanced, and within the portfolio there are quite a lot of nuances across geographies and across line of businesses. I think one dimension is on the retail side. We are very focused leveraging our strategic angle on volume growth, and for that we are leveraging a lot AI, as I was mentioning. So AI is really a unique opportunity to deliver unique type of experience to customers that before were not affordable and we could not offer to our customers. So that's one angle to it. And we see good developments in terms of volume growth into our numbers in retail between the first quarter and the second quarter. So there we are happy, but obviously we are also monitoring the competitive environment and the inflationary effect in some of those markets. In particular, very competitive still will be the UK as an example, where we remain very careful as well, right? And on commercial, we have a very broad portfolio, as you know, where we have large corporate, but we also have the platform business, which is very important for us in a forward-looking manner. We also have mid-corp and so on and so forth. So the dynamic there is very different. Obviously, large corporate and specialty is more impacted currently by some rate softening. But as an example, our platform business partner has been growing very nicely in the first half by more than 10%. So I think that's basically what we are exposed to currently.